think that it's really still a tug of war. You know, these two big forces are both have their hands on the rope. One side, in COVID, it's not just in the United States, but especially in the United States, we're seeing outbreaks. Tokyo today raised their alert level to its highest. And we're seeing outbreaks in other countries. And now it's a question of how people can handle this and how much it will impact the economy. And so I think that's one force, and you're right, I think that's a negative force. But I think that there's a sense of optimism still, partly because of the vaccines, partly because it seems clear from what the central bankers are saying that they're going to keep rates very low for a long time. Bank of Canada met earlier today, and so did the Bank of Japan, and both of them kept rates at their absolute lowest levels, and have indicated that if there's need to do more, they would do more. And they both indicated that so the door is open to more activity. We're going to get the ECB meeting tomorrow. They're going to say the same thing in essence, that they've eased policy a lot. The ECB lent over €1 trillion at minus 100 basis points. So there's just the idea that the optimism about the vaccine and optimism that officials will keep rates low for a long period of time. But here's what we need to know is that the economic data is dated, because a lot of the new shutdowns and rise of cases have only taken place in the last, say, 2 weeks. And so we need to have some very high frequency data to get a handle on this. And so some of the things that I'm looking at are like railroad car loadings. That is still trending higher on a week-over-week basis. I look at daily readings of consumer confidence. That's also heading up. And so I think what the market's taken away from the flare-up in the U.S. as well as in other countries is, yes, it's bad news, but it's limited in terms of its economic impact. I think that you're right that the third quarter is really what the game's about. Q2, we know at least in the United States, Europe, and Japan, Q2, the economy's contracted very sharply. We don't know yet how sharply, but we'll find out shortly how sharply. That is to say, U.S. reports Q2 GDP at the end of the month. But there still is an optimism that Q3 will be an expanding quarter. So, for example, the New York Fed, who has this GDP tracking model, they say the economy is going to contract by around 16% in Q2. That is at the low end of where people are forecasting. The Atlanta and St. Louis Fed are looking at something like twice that decline. But in Q3, their model is looking at 10% increase. And so I think that's a lot of people have this optimism that yes, Q2 is horrible, but this is as bad as it gets. We're not going to contract as much. And take a look at in today's industrial production report, we had a surge much stronger than people expected. And you dig below the headlines, and one of the drivers was in the manufacturing sector. And there, in June, U.S. auto factories output was 100% higher than it was in May. And so so what we're really finding is the auto sector is coming back online, and it takes more than a month for it to come back up. And so that's why I think people are a sense of why people are optimistic on Q3. Things are opening up a little bit in the U.S. The U.K., France, Italy. It looks like it's manufacturing led. In some countries like Spain and in Germany, it looks like it's service sector led. But it does look like a recovery of some. It's hard to know right now, but I think that's what the game is really. Yes, the recovery is underway. We just don't know how strong and how durable it is. Especially, as you noted, the virus is still potent in many of the U.S. states. You know, we've had like a couple of things that have characterized recent investing. Growth, that picks up your technology. Growth has outperformed value. The U.S. has outperformed Europe, and so many people are looking for this position to unwind. That is for value to begin doing better, and for Europe to begin outperforming the U.S. And I'm afraid that I'm old enough to remember that we've tried this, like we keep trying this every few months. People get in their heads, now's the time Europe's going to outperform for whatever the reason. But and each time it's like you're hopeful because of this huge catch-up, huge opportunity for when value does recover. It's just whether this is the time or not, and your guess is as good as mine. Yes, the U.S. economy, the world economy, took a major body blow. and it is beginning to recover. But it's not clear how strong that recovery is, how strong, like how much need the patient still has. And I think that we still have some challenging times ahead of us. That the real risk in these kind of situations, I think, and we keep repeating our mistakes, I think, after crisis, is we take away the punch bowl too soon. And so the recovery doesn't really catch on. And I think that it makes sense in this what central bankers call forward guidance to think about things about what level should we be raising interest rates? Should we take away the punch bowl when inflation begins rising? And just today we had another decline in import and export prices. And we've had soft, relatively modest price pressures. I mean, that is headline CPI below 1%. And so should we do that, or should there, and there's voices at the Federal Reserve who suggest maybe we shouldn't change policy, tighten policy, until unemployment is back to closer to full levels. And right now, at the peak in 08-09 financial crisis, we got to 10% unemployment. We're well north of that still now. And so I do think there is some forces, some parts of us, and that by us I mean people in the market, policymakers, intellectuals, at the universities, who think that we've gone too far and want to pull back on the, take away some of the punch bowl. And there's this, and I think that's what makes the markets now, is another force thinks that we keep repeating our mistakes. And I think that this is what the markets are sort of balancing out for us. Is it's not just a supply of money. And it's in a monetarist interpretation, right? If we had these glasses on and let us see the world the way a monetarist would. As you say, we want to focus on money supply, and central banks have made ample growth in money supply. Balance sheets have exploded. And so, but the other missing variable in this discussion really is the velocity of money. And the turnover is very slow. But if we do get a strong pickup in the velocity of money, plus or multiplied by the supply of money, I think then you'll see people get more concerned about inflation. But with high levels of unemployment, it's hard to see how it could be sustained. But it's possible, and that's why I think we're always on the lookout for it. And it's true also what you're saying is that when you look at the break-evens, the difference between the inflation-linked bonds and the conventional bonds, or later this week, the University of Michigan comes out with their survey, a consumer survey, and they ask people's inflation outlooks for, say, 1 year and 10 years. And those measures of inflation, that is, would be, say, market-based measures of inflation or surveys, are showing a small increase in expected inflation, though it's still below levels that prevailed before